Dollar cost averaging. With yesterday's sell-off, everybody on the internet is telling you to buy the dip and use dollar cost averaging. Well, what is it? Is it a viable strategy in today's market? And are there alternatives to use besides that? Hi, this is Doc with Ready, Set, Crypto with your 1-minute market report for Thursday, October 24th. Let's start off by defining dollar cost averaging. What is it? Dollar cost averaging is an investment strategy with the goal of reducing the impact of volatility on large purchases of financial assets. Now, DCA assumes that you have a large lump sum that you want to invest in, and breaking up that lump smooths out the volatility risk that you'll put it all in at the relative highs. Dollar cost averaging is then frequently confused with continuous automatic investing. So let's not fight the battle of semantics here. Let's assume that very few people that are listening to this have a large lump sum of money that they want to invest in a new asset through dollar cost averaging. So let's assume that cost averaging is more about investing on a regular automatic basis, okay? So how do we use dollar cost averaging? Well, there's two variables to cost averaging your contributions, and they're time and size. It has two variables: time, how often you will contribute. So is this once a week, once a month, once every 6 months? And then size, how much you will contribute. And you don't have a say. Once you put the system into place, you got to lock and load this thing, and you have to enter at every interval with the same position size, regardless of your feelings about what's happening at that particular time. Now, the benefit of doing something like this is that when the price is relatively high, you're buying less of a position. When the price is relatively low, you're buying more of a position. So this automatically biases the system towards entering more at lower prices, which over time is a good thing if your asset is going higher in price. Now, the problem, though, is that it's the same problem that gamblers face. If you double down your contributions as the price continues to go lower, this is called martingaling, and the problem is called risk of ruin. This is what all gamblers face. This is what we don't want to do. We don't want to be gamblers. You're betting that the asset someday recovers in price above your blended cost average. So one simple tweak, one piece of advice for you is that I would say invest in assets that are in a longer time frame uptrend, and then dollar cost averaging has a much better chance of working out well for you. Always have an exit in mind, no matter what your time frame is. But there is an alternative. I'm not suggesting that anyone try to time the market. We've all heard about people say, don't try to time the market or anything like that. I'm not suggesting that, but you could look to enter for Buffett entries only. Now, Warren Buffett famously said, be greedy when others are fearful, and fearful when others are greedy. You can see these types of emotions on any price chart where people are greedy and people are fearful. So what we can do is we can mechanically invest. There are many different tools which can provide fear entries in the context of a larger uptrend. In theory, these entries would be more efficient than randomly timed ones because you are getting in close to the relative bottom for that time. The challenge with this technique is going to be sticking with a plan. Just like with regular time-based dollar cost averaging, you're going to be entering when things are somewhat chaotic, and it's not going to feel very good to enter, but you got to stick with that plan. So let's summarize here. Point number one, DCA is technically meant to help spread out lump sum investing. Probably not that many people doing this. Automatic contributions are what most people assign to DCA. These contributions have time and size variables defined. Point number two, an alternative method for those familiar with charts and technical analysis would be to define value entries instead of random regular ones. And then point number three, dollar cost averaging is just one of the 101 steps to your financial freedom course that we just released. This course is included for our Ready, Set, Crypto Omnium members. So consider either joining the class for $47 on sale right now, or join us as an Omnia member and get it included with your subscription. So that's dollar cost averaging. What do you think? Are you going to use it to buy the dip? Let me know in the comments below. Thanks for listening, and we'll see you in the next edition of 1 Minute Market here at Ready, Set, Crypto.